All right. Good morning, everybody. Markets are waiting. Got a lot of data on the table. Whatever they're waiting for, it's not in today's economic data. So got some ranges to focus on. The spot gamma 1-day estimated move. GTFO, get out of that box and we could really expand, but it's hard to see us do that before we get the data that the market's waiting on. We had some really big events on the horizon. Looking at the markets right now, there is some big legacy names like McDonald's getting whacked, which is bringing the Dow down some, but that doesn't account for other things like the Russell and even the global markets being down like they are. So we've got a lot of Fed speakers from US, Canada, Europe. We got rate decisions, and then late today we've got Japan also coming out with a Fed speaker. Anything that you're trying to swing, you're really going to want to keep your eye on that data coming out in the later part of today and through the overnight with Canada or with Japan. We also have the 20-year bond auction today. I think I wrote somewhere it was the 10-year, but it's the 20. They don't show it as a high impact situation, but that's one that you want to pay particular attention to. Don't let that one slip by you. So really watch the clock. Anytime we have those auctions, they never show it as a high impact, but you want to pay particular attention to the clock when we have those auctions. So as you can see, we've got Christine Lagarde. That's like Europe's version of Powell. Bank of Canada, a lot of different Fed speakers in the US, the Beige Book, and then Japan at 3 o'clock. It's just going to be coming at us all day long. So keep your eye on the market maker move. If you don't have Thinkorswim to have that little tag, you can still check and see if there's a market maker move as long as you have an options chain. And I'll show you where to look. So that phrase market maker move is something that the people who created Thinkorswim, Tom Sosnoff and that group, they're the ones that came up with this. And you can see right now this morning, we don't have a market maker move, but through the day today, if any of these events that are later today are going to be the cause of why we're waiting, you'll see this front implied volatility get higher than the next expiration out. If and when that happens, you'll see a label up here that has the MMM market maker move attached to it. We don't have it right now, but it's what I would be looking for through the day. The base case argument is that whatever the market is waiting on, it's not in today's economic events. So I would expect it to not show up today. If it does show up, well, at least you'll know to be looking for it and to be ready. And it's likely the kick that the market needs to get out of this box, and that is the box right there. If you look at the spot gamma levels, it has the 1-day estimated move across the top, which lines us up back here, and the 1-day estimated move on the bottom, which lines us up back here. So that is the range that we have to get out of. We're down about 1/4%, which puts us closer to the lower ADR than the upper ADR, but not by a whole lot. There's not a whole lot of edge here. If we were a lot closer, then we could say, yeah, it's probably likely we just go ahead and hit that level because we're so close to it, but we're not really all that close. At this point, I would be looking for reciprocation outside of the zigzag that we've got here with VWAP. So whatever we get on one side, look to get it on the other side, maintain the range, hold the line, waiting on data to get out of the box. All of this is just waiting on data, waiting for a reason. Another way you might heard it said is looking for an excuse. The markets won't sit like this forever. They'll either get the data that they're waiting for, or they'll give up on waiting on the data and they'll flush it. So really just need to see it play out. We got to get out of the box either way it goes. We're still chopping around that weekly floor pivot, 58.95. So far, it's like a gravity. We're just cutting above and below. The daily floor pivot channel is lower than yesterday's channel, but price opened above it. So that's more of a, if we say one of those actions is bullish because we opened above the channel, but the other action is bearish because today's channel is lower than yesterday, they kind of cancel each other out. And we're back to neutral. Since we are under the weekly floor pivot, that does put us in a bearish bias on the week. We need to get above that weekly floor pivot and then get out of the box. As you can see, we're interacting with the 10-day. We've been doing that for the last few days. So 10/21, we bounced. 10/22, we bounced. But you'll notice we're getting lower highs each time. So we're bouncing, but the recovery isn't as strong each time we bounce. Now we've got yet again another lower high. If we were using OCR, one candle reversal style analysis, then this isn't looking good. Lower highs, lower lows. We breached that 10 yesterday. Sure, we managed to run back up, but setting that lower high and then today setting another one. This is building a wedge. We've still got the candle of control back here, but we're underneath the 50% mark. And now that we're building this wedge, winding up a lot more energy. This thing is just getting primed and ready to go. Now, none of that is directional in bias. It's not implying that we're going to make an up move or a down move. It's just implying that when the move comes, it's very likely going to be a significant size. $58.32 cog line to the downside is also where the 20-day moving average is at. No surprise that the box that we built lines up with last week's volume profile. Last week's point of control is way behind us. Really not too much to worry about. If we do get any attempt to make a run to the upside, we got to get through last week's point of control and then 59.11 cog line, but really not seeing a reason to head in that direction yet. We'd also have 58.92 cog line and 5,900 round number. So a lot of resistance to the upside to get through if we're going to try that. 58.32 As I just mentioned, that's the 20 period moving average, but it's also the point of control for a couple of weeks ago. So that's an untouched point of control for this week back here. That lines up, it's multiple pivot points, right? It's a 20 period moving average, it's a point of control, it's a cog line. So getting down to that level, I don't think would be too hard. Getting through that level and getting below it, that would take very likely some sort of economic event, some big news, something like that. We also have the 3-week moving average underneath this. We're now underneath the volatility trigger, but we still have 0 gamma, and the 10-week moving average, which is right above the put wall at 57.50 and 57.42. It's a long ways off, but it does show that if we make those kind of breaks to the downside, there is something down there. 57.31 cog line for also lines up with a 10-week moving average. 57.50 to options level lines up with a 10 period moving average. Just depends on whether you're using the EMA or the SMA. Volume from the overnight sitting in the 60s. It's a little light, nothing horrible. We've seen less than that. It does show a little bit of sitting out, but we're not seeing hedging brought with it. So it doesn't seem like they're, overly concerned in sitting out. Just seems more like they're waiting on an excuse or waiting on data. Spot gamma seems to be implying that the election is so big and such a concern at this point that the lack of trading that we're seeing ties back to that. I really hope they're wrong. Otherwise, we've got a long wait. Imagine having this kind of market for the next 2 weeks, because that sure doesn't sound good. 10-day, 30-minute volume profile. We got more of a classic P shape at this point. We really cleaned up the profile over the last few days. A lot of those smaller high volume nodes that were sticking out that had this thing looking really choppy, they're gone. So if we look at the TPO in blue, that's more of the classic P with the point of control and the profile across the top. The volume profile isn't quite as clean as that yet, but through the day today and into tomorrow, we're going to clean it up a little bit more. And if we don't break below 58.50, then by next week, we will have a very narrow range that could look a lot like that. That's a 75-point range. It's really tight. It just highlights the lack of movement out there. Movement is another word for volatility. And this is showing that lack of volatility, which is an indication that something is on the horizon that the market is concerned about. Five-day, 5-minute volume profile with TPO. We don't have a point of control to carry from yesterday if we're looking for a VPOC, because it would have already been hit. Now, the textbooks will tell you to carry these lines forward. So value area high, low, and the point of control, you would carry them into today's range, looking to see what price does if it happens to hit those levels. It's an area of interest. I've got enough pivots, so I generally don't carry them forward just on general principle, but you certainly could, especially if you don't think you've got enough pivots. Which implies if we break down lower today, if we break our own Globex low and we continue to the downside, before we get into yesterday's lows, we're going to hit that value area low line, 58.65. If you think about it though, which is the way that I usually work this issue, is that's Globex low, or really close to Globex low. This one actually is the Globex low, but it's close enough. That'd be a level of interest to me anyways, even without using the value area low, value area high. It was Monday's low, so another reason that it would be on my radar. It's just the way it works, right? These lines generally will line up with something else, gives you confluence, because you get agreement from multiple sources on the level of interest. Looking at the range for the week, we really haven't done anything. We haven't gone anywhere. We've barely expanded from that 59.07 close. And here we are at 58.80 from Friday till now, like a hamster on a wheel, just running in a circle. We're not getting anywhere. So GTFO, we got to get out of the box. The easiest way to build that box is just come out to the daily and focus on October 14, that really big bar. That's your high, low, and midpoint, and then you can use that bar for your projections higher and lower. 50% higher, 50% lower, 100% higher, lower. We had really nice recovery days in the last 2 days, those kind of V-bottom basing flip and then run back up, still closing lower than where we opened. Now, there's a history of that. The S&P is really good at just doing the same thing over and over and over again. So, you kind of get familiar with the dance, right? The kind of steps that it takes. This can play out multiple ways. One would be that we just go sideways, staying within that Monday bar that I was talking about, chopping until we get news, and then getting a real big leg down or a leg up. The other one is like the phrase, the 1, 2, 3 fail setup comes to mind. And this would be the third try. Either way, we got the levels set. All we got to do is get the breakout. It's really what we need to. We got to get the breakout. So we're at the 10-day. We've faded back nicely. Wouldn't surprise if we get a little bit of an overshoot like we did earlier in September. It could get a little more ugly like what we had in August. But at this point, it's all going to be data driven. So trying to anticipate what we're going to see in the S&P over the next 2 weeks is like trying to guess what's going to happen at earnings. We have no idea how a company's earnings is going to come out, and we have no idea what's going to happen to the S&P because we're looking at things like the election and global rate decisions. That's a coin toss. There's no reason to try to guess or assume that we can pick a direction when we don't know what the news is going to be. This is 9 markets. The top 3 are the risk on, bottom 3 are risk off. The middle 3 are the midline. And the label that's in the corner of all of these goes back over a 5-day period. And if we look at what's been happening in the markets over the last 5 days, almost all of these markets are down. Even the one that's up, the technology, is only up 1% over the last 5 days. Energy is basically at zero. It's positive, but less than a tenth. So when we were all looking for this rising tide lifting all markets, that it wouldn't just be tech that was going up, that it would kind of broaden out and it would be everything that was going up. Yeah, well, we're getting that falling tide now. It's not just tech, it's everything that's going down. We need to find a little bit of a stability to this and see how the capital rotation is going to play out. So this morning we've got Bitcoin down, the Mag 7, uranium, those are all down at least 0.5%. Semiconductors are down, but they're not down enough. Same with bonds and energy. They're down, just not down enough to meet our benchmark. The China ADRs are up, at least the KWEB constituents, and we can see the China MSCI ETF is also up. Don't see emerging markets yet, but I would expect that's going to be up as well. But that's it, right? Like, we got China and VIX. That's not what we want to see if we're expecting some sort of rally today. Precious metals also down. So, gold's had one heck of a run. It makes sense that we're going to see a little bit of a pullback, not just in gold, but in precious metals. Dollar also had a really good run. Got to expect that it's going to pull back a little bit at this point. The 10-year made one really big move, and won't be much of a surprise to see the 10-year pull back a little bit as well. So say like the TNX. Back above 4.2%. This wasn't even supposed to get back above 4.1. And well, we've completely shot past that. In the S&P, 14% is down at least 0.5%. McDonald's with news, so that's not too much of a surprise. Starbucks, I believe that's earnings that knocked it back. They removed their forward guidance because they got that new CEO and they're trying to give them a clean slate. But the market didn't appreciate that, knocked it down. So both of those are news. Boeing's just a dog, so it's not a surprise that it's down. And then software, electronic technology, we can see Apple, NVIDIA, General Dynamics, also, I believe, earnings. Looking at the NASDAQ, names that are down at least 0.5%. See a lot of semiconductors in there this morning. Otherwise, it's kind of all over the place. Technology, manufacturing, consumer services. This isn't what we want to see if we're looking for a coordinated rally back up. So we do have the China group up, but it's just a little gap up. And at the moment, we're inside day breakout. It needs to keep that. If we get back inside of yesterday's range, I think it'll be harder to get back out of it today. Look at the K-Web group. They never really made it out. Kind of poked their head up, gapped out, and came right back in again. So if we can't get this to get a sustained breakout, then it's hard to see those China ADRs doing anything today. That'd be the BABA, Baidu, JD, PDD group. I had mentioned pot stocks have an event coming soon. It's in November, but to kind of keep your eye on those, they're also connected to the election, right? There's the presidential trades. Each candidate right now has like a basket of stocks connected to their policies and proposals. There's a good move in MSOS. See if it sticks. At this point, we're just kind of chopping around after the end of that move from yesterday. A continued run, by the way, gets us back up to the anchored VWAP for the year. So above 8, looking at like 8.25. Healthcare, it says healthcare is up this morning, but it's just a little algo print. You can see that little dot right there. So these little dots can come from a number of things. That could be a dark pool print from the previous day. It can be just there's a lot of different buying, right? So it could be reported volume from corporate buybacks. It could be, there's so many things that could cause that little prearranged buy order at that price. Even if, we close down here and we don't get any other trading at that price. If it was an agreed upon price, big order got taken out. It doesn't look like, say, K-Web, where we've got actual bid and ask and orders being taken and more than one trade going through and actually forming candles. It's just this little dash, right? This little transaction that took place, and that's it, right? So an algo print, it's basically just a transaction that took place. No flow. Yep. And depending on who you're using, you might see those really crazy long wicks. We don't see it here on TrendSpider, but you can see it a lot of times on TradingView, and it'll just be this really long, wild wick. And a lot of times that's like a dark pool print too. But it's easiest just to think of it as a computer that was told, hey, there's a buy here, and usually prearranged, predetermined, pre-agreed upon trade price. And nobody else wants to play it at that price. You'll see it also on things like IGV. This rarely ever gets pre-market activity from like actual trading, but we'll see these algo prints a lot. So this is a really dangerous market right now. It is primed and ready to go. We're waiting on data, but I think that data that it's waiting on is so far out that it's going to give up and start to micro focus or hyper focus on these little minor events that normally wouldn't command such attention, right? Like, I would just be very careful for every single economic event on the table, because if this market is sitting around waiting on some big event that's 2.5, 3 weeks out, it's going to just start to get bored and really over manage these smaller events while it's waiting. And there's a lot of stuff coming. Next week, we're going to get QRA, and that's a really big deal. So it'll be on the 28th and the 30th. And that doesn't even account for all these really big earnings that are coming out too, right? So there's just a lot on the table. The easiest way to focus on it at this point is we got to get out of the box. And it doesn't matter if you use the SPX, the SPY, the ES. You can see the really big days on SPY. It looks like you could use either one of those, but on the ES, the 14th is the better choice. But we got to get out of that box. And with Japan having that big data tonight, we had that really big run up. We're back above 153. Got the dollar back above 104.5. There's some really big moves there. And we got the 20-year auction today, 1 o'clock. It's a big, really big deal. Keep your eye on that. And that's what I got. Watch the clock. We're not seeing a market primed and ready to go. We're seeing a market that is building bunkers and sitting in this sideways range, and it doesn't look like it's going to get out of the range anytime soon. Which means if we test those edges, that it's very likely we'll come back in again, right? That means you'll want to sell into strength across the highs, buy into weakness across the lows, and expect that we're going to continue to hold the line until we get the data that we're looking for. Everybody, be careful, be safe. I'll see y'all tomorrow.